Welcome back to the Deep Dive. It is Monday, February 23rd, 2026.
And if you're listening to this on your commute this morning, just take a second to look at the houses you're driving past.
Yeah, or if you're listening at home, just look around your living room. Because today we are tackling a subject that is, well, it's pretty much haunting every group chat right now.
Every dinner table conversation.
Exactly. And definitely every bank account in the country.
It's the elephant in the room.
Oh.
Or, given the 2026 market, maybe it's the elephant in the 400 square foot studio apartment that costs $3,000 a month.
Too real. That's entirely too real. But we're talking about the American dream today.
The classic script.
Right, the script we all know. It was handed to us practically at birth, I feel like.
Oh, it's in our DNA at this point.
You go to school, you get a steady job, you scrape together a down payment.
By skipping avocado toast, obviously.
And then you buy the house with the white picket fence, and you just sort of ride off into the sunset and retire on the equity.
That's the golden ticket, the ultimate path to stability.
Right. It's been the narrative for, what, the better part of a century?
Easily. It's the bedrock of middle-class wealth creation, or at least it's the forced savings vehicle that built the boomer generation's wealth.
That's what we've always been told. But here we are, it's February 2026, and I think a lot of people are looking around at the current state of the market, at their stagnant wages, at these interest rates.
Which are still stubbornly high.
Right, and they're asking a very terrifying question. Is that script broken?
Are we sleepwalking into a financial trap?
Yeah, following advice that might have worked brilliantly for our parents in 1985, but is actively harmful to you today.
It's a massive collision of two forces. On one side, you have this immense cultural wisdom.
Right, sure.
The pressure from your parents, from society, even from your own internal psychology that just repeats renting is throwing money away, buying is always best.
It's treated like a rite of passage into adulthood. If you don't own, you're just a permanent teenager in the eyes of some people.
Exactly. But then on the other side, you have the hard data of 2026. And what we're finding in the source stack today, and we have a really massive stack to go through, is that the math and the culture are at war.
The spreadsheet is screaming one thing, and the heart is screaming another.
That's the perfect way to frame it.
So our mission today is to strip away that emotion. We're going to put the whole home is where the heart is stuff on the shelf for just a minute.
No HGTV renovation fantasies today.
None. We're looking at the cold, hard numbers to answer one question. Is buying a home actually a good investment in 2026?
And to do that properly, we've pulled together a really diverse stack of sources because you can't just look at one angle here.
Right, we're not just reading Zillow listings.
No, we have deep economic commentary from the Federal Reserve Bank of Cleveland, which dives into wealth inequality and risk.
We have the latest 2026 market analysis from JP Morgan giving us the lay of the land right now.
We also brought in data from Zillow and Thumbtack on the really nitty-gritty costs of maintenance, the stuff that breaks.
And some fascinating investment white papers from Geometric Wealth Advisors and PWL Capital that, honestly, they completely challenge the way we think about building wealth.
Plus some cultural insights from Landing and Reddit about how the vibe is shifting among younger generations.
So we are covering everything from the macroeconomic view all the way down to the cost of fixing a frozen septic pipe.
Which is more than you think.
Oh, we will get to the septic pipe. But let's unpack this. I want to start with the sticker shock, because I think everyone knows house prices are high.
That's definitely not news.
No, if you've opened a real estate app in the last 3 years, you know prices are absurd. But there is a silent killer in the housing market right now that I really don't think people are budgeting for.
You're talking about the hidden costs.
I am. We looked at this joint analysis from Zillow and Thumbtack, which came out late last year, November 2025. And they put a specific price tag on the stuff nobody talks about at the closing table.
The unrecoverable costs.
Right. I want you to guess. Well, you've seen the numbers, but imagine you hadn't. What would a normal person guess the average annual hidden cost is?
I mean, usually people think about property taxes, maybe a little insurance. So maybe a few $1,000, $5,000.
Try nearly $16,000.
Ouch.
Specifically, $15,979 per year for the typical U.S. homeowner.
Wow.
Just let that sink in for a second. That is not the mortgage.
Not the principal.
Not the interest paid to the bank. That is literally just the privilege of keeping the house standing and insured.
That's a staggering number when you break it down. That is roughly $1,325 a month on top of your mortgage payment.
And this is where the rent versus buy calculators completely fail people, right?
Absolutely. When people use those online mortgage calculators, they see the principal and interest. Maybe the tool estimates a little bit for taxes if it's a good one.
But they rarely factor in an extra $1,300 a month just vanishing from their account to tread water.
So what is eating that money? Where is it actually going? Because $1,300 a month is, that's a luxury car lease.
It's a second apartment in some secondary markets.
Exactly. So where is it going?
Well, the biggest chunk, according to Thumbtack, is maintenance. That's coming in at $10,946 a year.
Just on maintenance.
Yeah. Then you have property taxes averaging about $3,030 and insurance at $2,003.
But here's the real kicker with those numbers. Those costs rose 4.7% in a single year.
Which is significantly faster than wages are growing.
Exactly. Income growth over that same period was around 3.8%.
So the cost of merely holding on to the property, just keeping the rain out and the tax man away, is outpacing the raise you got at work.
You are technically getting poorer just by standing still in your own house.
I really want to stop on that maintenance number for a second. Nearly $11,000. Because that feels high to me. I think a listener might hear that and go, no way, I don't spend $11,000 every single year on my house.
That's the most common reaction. People say, my roof is fine, my windows are fine, I didn't spend 10 grand this year.
Right.
But Thumbtack calls this the death by 1,000 cuts. It is rarely one massive $11,000 check written all at once.
It's the small stuff.
It's the gutter cleaning for $300. It's the HVAC tune-up for $200, so your AC doesn't just die in July. It's the lawn care, the fertilization, the pest control, the pressure washing.
The things you don't really notice until you stop doing them, and the house looks terrible.
Precisely. And then, every 10 or 15 years, you do have the big one.
The water heater explodes.
The roof needs replacing. The foundation needs work. The $11,000 is an annualized average. Some years you spend $2,000 and some years you spend $25,000.
But if you aren't saving that monthly average, when that big bill hits, you are in deep trouble.
And we have to mention that the size of the home matters immensely here, because the American dream isn't usually a one-bedroom condo.
It's a big house with the yard.
Right. And a large single-family home with a yard has significantly higher upkeep costs than a townhome. You have more roof surface area, you have more pipes in the walls to leak, you have more grass to water and mow. It all just adds up to more entropy attacking your wallet.
Entropy attacking your wallet. I love that. I want to zoom in on the insurance piece of this pie, too, because this feels like the area where things are just really going off the rails.
It's a full-blown crisis at this point.
We're seeing headlines everywhere about it, but the data is startling. Nationwide, premiums are up 48% over the last 5 years since 2020.
That is a massive spike. Just imagine if your grocery bill went up 50%.
Well, bad example, it probably did.
Fair point. Bad example. But imagine if your Netflix subscription went up 50%. You just cancel it.
But you can't cancel home insurance if you have a mortgage. The bank won't let you.
Exactly. You are a captive audience.
And those national averages hide the real localized pain. If you look at specific danger zones, the numbers are eye-watering.
Give us the horror stories.
Okay, take Miami. The average premium there is now $4,607 a year. That is up 72% in 5 years.
That's almost doubling.
And it's not just Miami. Jacksonville, Tampa, Orlando, they're all seeing increases hovering around 70%.
That destroys a monthly budget. And it's not just a Florida problem.
No, it's spreading. California's seeing it too. Riverside is up 56%, Sacramento up 59%. And if we connect this to the bigger picture, it is directly tied to climate risk.
Which we saw in the daily upside reporting.
Right. Insurance companies are businesses. They aren't charities. They look at the data on floods, wildfires, extreme weather events, and they are saying this is simply too risky.
They are modeling the next 20 years of climate data, not the last 20. So they're either raising rates aggressively to cover that catastrophic risk, or in some cases, like we've seen with major carriers in California and Florida, they are just retreating entirely.
They're saying, we won't insure you at any price.
Which leaves the homeowner completely holding the bag. If you can't get insurance, or if the insurance costs more than your mortgage principal, the asset basically becomes a liability.
You literally cannot sell a house to someone who needs a mortgage. if they can't get insurance on the property.
Precisely. The value of the home could technically plummet if it becomes uninsurable. And I think this brings up a really key takeaway for the listener who might be renting right now.
The FOMO crowd.
Yeah, you might be feeling fear of missing out, but remember, you don't pay any of this directly.
Well, your landlord pays it.
Your landlord writes the check. Now, sure, they try to bake some of those rising costs into your rent, but rents are ultimately dictated by the local market supply and demand, not just the landlord's personal expenses.
If the water heater breaks in your apartment, you call the super. You don't drain your own emergency fund.
You don't have to miraculously find $15,000 a year just to keep the building standing.
That's the liquidity difference. As a homeowner, you must have the liquidity, the cash on hand, to absorb a $5,000 repair bill instantly.
As a renter, your costs are generally fixed for the exact term of the lease. That predictability has a massive financial and psychological value that people often just undervalue.
It's the value of sleeping at night knowing you won't have to buy a new roof tomorrow morning.
Exactly.
So, we've established that the carrying costs of a home are skyrocketing. $16,000 a year is a serious hurdle. But the counterargument is always the investment angle.
Always.
I can hear the audience yelling at their speakers right now. They're saying, okay, sure, it costs money to maintain, but I'm building equity. Renting is just throwing money away.
That is the phrase that absolutely refuses to die, throwing money away.
I hate it. It makes renters feel like idiots.
It really does, and we need to dismantle it today. Because when we look at the data from geometric wealth advisors, the picture is shockingly different from what that cultural wisdom suggests.
Here's where it gets really interesting, because they compared the performance of housing versus the stock market over the long term. And this isn't just a last 5 years thing. This is deep, deep history.
And the results aren't even close. They found that $1 invested in the stock market, specifically looking at the S&P 500 in 1945, would be worth nearly 50 times as much today as $1 invested in housing.
Wait, 50 times, not 50%.
50 times. The multiple is massive. The growth rates really tell the story here. Stocks grew at about 10.6% annually. Housing grew at about 4.6%.
4.6% versus 10.6. I mean, on paper, that sounds like a 6% difference. Significant, sure, but maybe not world-ending to a layperson.
But that's where the magic and the danger of compounding comes in. A 6% gap compounded over 80 years is the difference between retiring in a luxury villa and retiring in a shed.
That gap becomes a canyon.
It really does.
But wait, people see their house prices going up? I had to play devil's advocate here for a second. My parents bought their house for like $50,000 in the 80s, and now it's worth $500,000. That feels like a huge win. You cannot tell them they didn't make money.
It feels like a win. And nominally, in terms of the raw number of dollars, they did make money. But it is largely an illusion.
Illusion.
Yes. This is where we have to bring in the Yale economist Robert Shiller. He's the Nobel Prize winner who basically invented modern housing data analysis. He tracked home prices going all the way back to 1890.
The 19th century.
Right. And his data shows that when you adjust for inflation, when you actually account for the fact that $1 today buys way less milk and bread than $1 did in 1980, the real annual return on home prices is only about 0.4%.
0.4. That is, I mean, that's basically zero.
It is basically zero. It's a rounding error. Most of the massive gain people see when they sell a house decades later is just inflation. The house didn't necessarily become more valuable in real utility terms. The dollar just lost its purchasing power.
So the house is essentially just a savings account that barely keeps up with inflation.
At best. Ideally, it's a store of value, kind of like gold, but it is not a productive asset. And that is the absolute key distinction Geometric Wealth makes in their white paper.
Break that down for us. Productive versus non-productive assets.
Think about a stock. When you own a share of Apple or Nvidia or Costco, you own a piece of a living, breathing company that is waking up every single day trying to make more money.
Right.
They're innovating, they are cutting costs, they are selling new products globally, they are productive, they generate actual earnings.
Okay, now look at your house.
Exactly. Look at your house. It's a pile of wood, bricks, and drywall sitting on a plot of dirt. It doesn't do anything.
It doesn't invent a new iPhone.
It doesn't sell bulk hot dogs. It just sits there and slowly degrades while you pump money into it to keep it standing. Economically speaking, it is a consumption good.
That is a harsh reality check.
Yeah.
We consume housing. We don't really invest in it in the same way we invest in a business.
Right. And this brings us to the concept of opportunity cost. I really feel like this is the renter's superpower that nobody talks about.
It absolutely is. Opportunity
Because
cost is simply asking the question, what else could I have done with that money?
exactly, if you take a $100,000 down payment and lock it into a house, that money is stuck. It is literally cemented into the foundation. It's dead equity.
But if you took that same $100,000 and put it into an S&P 500 index fund, historically, it grows at that 10.6% rate we talked about.
The Daily Upside had a really great example of this in their reporting. They talked about the finance bros.
Oh, yes. The high-income earners in New York or London finance. You would think these guys who literally know money better than anyone else on earth would be buying the biggest mansions they can find.
But often they don't. They rent luxury apartments. We're talking $20,000 a month in rent.
Which sounds completely insane to the average person, burning 20 grand a month.
It sounds incredibly wasteful. But you have to do the math. To buy the equivalent luxury penthouse, they might have to drop $6 or $7 million. A 20% down payment on a $7 million place is $1.4 million.
So they have a choice. Lock up $1.4 million in a condo or keep it liquid in the market.
Exactly. They know that keeping that $1.4 million liquid in the market, earning a historical 10%, is worth $140,000 a year in returns.
Plus, they avoid the property taxes, the maintenance, the exorbitant insurance.
They realize that losing money on rent is actually cheaper than the lost investment returns of tying up millions in a physical structure that barely beats inflation.
So they are paying rent specifically to keep their millions free to work for them. That is the definition of making your money work for you.
Now, I have to add a caveat here, because listeners will be yelling at us, what about 2020? Or what about the mid-2000s?
The boom times.
Yes, there are exceptions. If you cherry-pick specific periods like the housing bubble of 2004 to 2006, or that wild post-pandemic mania from 2020 to 2023 housing can beat stocks over a short window.
If you bought in 2019 and sold in 2022, you look like a financial genius.
You won the lottery. But that is timing. Over any long-term horizon, say 30 years or more, stocks win almost every single time. Betting on housing is betting on a specific window of time in a specific localized location.
Whereas betting on the market is betting on the entire global economy growing.
Precisely.
So if the math is so clearly in favor of renting and investing the difference, why does the data usually show that homeowners are wealthier than renters? You see these charts all the time, right? Average homeowner net worth, $300 Ks. Average renter, $5K. There's a massive disconnect there.
This raises a really important question about human behavior versus pure math. The Federal Reserve Bank of Cleveland and PWL Capital both touch on this in our source stack. It's the classic correlation versus causation trap.
Right. Is it that buying a home makes you wealthy, or is it that wealthy people buy homes?
It's overwhelmingly the latter. People with high income, stable jobs, and good credit are the ones who actually get approved for mortgages in the first place. So the homeowner pool is already self-selected to be wealthier from day one.
But there's another factor, right? Forced savings.
This is honestly the strongest argument for homeownership. A mortgage is a bill you simply cannot ignore. If you don't pay it, the bank takes your house. You have to pay it every month, and a portion of that payment, the principal, goes toward building your equity.
It forces you to save money whether you want to or not.
Whereas the renter faces what we call the renter's trap.
The renter's trap.
To beat the homeowner mathematically, the renter absolutely must take the difference, the money they saved by not paying for a new roof, or the difference between their cheaper rent and a comparable mortgage, and invest it religiously every single month.
And let's be honest, humans are terrible at that.
We are so awful at it. We see an extra $500 in the checking account at the end of the month, and we don't think, time to buy an ETF. We think, time for a weekend trip, or time to upgrade my leased car.
So the house acts as a giant physical piggy bank that you can't easily break open. It protects you from your own spending habit.
Exactly. PWL Capital notes that for a highly disciplined renter, someone who automates their savings and invests in a low-fee, diversified portfolio renting can equal or even exceed owning in terms of wealth creation.
But it requires a level of discipline that most people just don't naturally possess.
What about leverage, though? That's the other big argument for buying that always comes up. I can put 20% down, but I get the appreciation on 100% of the home's value. That feels like a cheat code.
It is a cheat code. Leverage magnifies returns incredibly well.
Yeah.
If you put $20,000 down on a $100,000 house, and the house goes up 5% to 105,000, you just made $5,000.
Right.
That's a 5% return on the house, but a 25% return on your initial $20,000 investment.
That sounds amazing.
It is amazing when prices go up.
Yeah.
But leverage is a double-edged sword. It magnifies losses just as fast.
Right.
If the house drops 5%, you just lost 25% of your equity. If it drops 20%, your equity is wiped out completely. You are underwater, you owe more than it's worth.
And the Cleveland Fed pointed out something really interesting about leverage over time. It doesn't last forever.
No, leverage decreases. As you pay off the loan, you own more of the house. Your debt goes down. So your leverage ratio drops steadily. By the time you pay off the house completely, you have zero leverage.
You're just holding a giant pile of cash in the form of a house.
So to keep that high-octane return, you'd have to keep refinancing and constantly pulling cash out.
Which adds immense risk and transaction costs. And here is the crucial point for 2026 specifically. In a flat market, which, spoiler alert, is exactly what JP Morgan predicts for this year, leverage actually hurts you.
How so?
Because you are paying interest on a massive loan to hold an asset that isn't growing in value. The interest costs, that 6 or 7% you're paying the bank right now, are actively eating away at your equity. You are paying the bank for the privilege of holding a stagnant asset.
Okay, so we've busted the investment myth, we've looked at the carrying costs, but there is another layer to this onion: risk. We usually think of renting as the risky move because the landlord can raise the rent or kick you out. Owning feels safe. Nobody can kick me out.
That is the widespread perception. But the Cleveland Fed has a framework that flips this script entirely. They call it the 3 risks of homeownership, and they specifically highlight how these risks disproportionately hurt lower-income households. But honestly, they apply to everyone.
Let's walk through them. Risk number 1, location risk.
This is diversification 101. If you are a financial advisor, you would never, ever tell a client, take 80% of your net worth and put it into one single stock.
That would be malpractice. You'd lose your license.
But that is exactly what homeownership is. You are tying a huge chunk of your wealth to one street, in one neighborhood, in one city. You are placing a massive, highly leveraged bet on the local economy of that specific zip code.
You're putting all your eggs in one geographic basket.
Exactly. And you cannot predict the future of a city over 30 years. Look at the data from the year 2000 to now. If you bought in San Francisco or Seattle, you saw skyrocketing growth. You won the lottery.
The tech boom lifted everything.
But if you bought in Cleveland or parts of Chicago or St. Louis, your growth lagged significantly behind the national average. In some specific neighborhoods, real values actually went down.
And unlike a stock portfolio, where if one company fails, you have 499 others in the S&P 500 to balance it out.
Right. If your city's economy tanks, if the main factory closes, if the tech hub moves to another state, your net worth tanks with it. And you are stuck.
Renters have mobility.
They do. They can chase the boom towns. If the job is moved to Austin, the renter can pack up and move to Austin. The homeowner is anchored to a sinking ship.
Which leads right into risk number 2, timing risk.
Duration matters immensely in housing. We talked about how housing barely beats inflation over 100 years, but in the short term, it is incredibly volatile. Buying in 2006 was a financial disaster. Buying in 2012 was a stroke of absolute genius.
But you don't always get to choose when you buy or sell. Life happens.
Exactly. Divorce, sudden job loss, a death in the family, a forced relocation. These life events force you to sell. And if you are forced to sell in a down market, you get absolutely crushed.
And the transaction costs are brutal, even in a good market.
They are. Selling costs about 6% in agent commissions. Buying costs another 2 to 3% in closing fees, transfer taxes, inspections. You start 8 or 9% on the whole the very day you get the keys.
So you need the house to go up nearly 10% just to break even on the transaction.
Which typically takes years. You usually need to stay in a home for 6 to 7 years just to break even on those fees. If you have to sell in year 3 because you got a new job across the country, you are almost guaranteed to lose money.
And then the third risk, which I honestly think is the scariest one, liquidity risk.
This is the one that keeps financial planners up at night. Houses are highly illiquid, and that is just a fancy financial word for hard to turn into cash quickly.
You cannot sell a bathroom to buy groceries.
That is the perfect image. If you lose your job in a deep recession, you need cash to survive. But in a recession, house prices often drop, and it takes months to find a buyer and close a sale.
So precisely when you need the money the most, when you are the most vulnerable, Your biggest asset is trapped behind months of red tape.
Or you have to sell at a fire sale price just to get out, destroying your wealth in the process. You become a distressed seller.
Compare that to stocks.
Right. If you have $500,000 in the market and you need $5,000 for an emergency, maybe a sudden medical bill, you click a button on your phone. You sell a tiny sliver of your portfolio.
The cash is in your checking account in 2 days.
And the rest of your money stays invested and keeps growing.
That flexibility is a massive safety net that homeowners willingly give up. They trade liquidity for, what, a backyard?
A backyard and the illusion of total control.
So we have the carrying costs, the stark investment comparison, and the 3 massive risks. But we are humans. We're not calculators. We have to talk about the white picket fence emotional appeal. Does buying a home actually make you happier? Because ultimately, that's what we're all chasing, right?
This is where the cultural narrative really crumbles under scrutiny. PWL Capital cited 2 major studies, one from 2021 by Latif and another from 2022 by Odermatt and Stutzer. They specifically controlled for things like income and health. They wanted to isolate the pure homeowner effect.
And what do they find?
The verdict. Owning a home has no significant positive impact on overall life happiness.
Really, no impact at all. All that stress, all that money saved for a down payment, and you aren't even measurably happier.
In fact, for some demographics, it is actually negative. The constant stress of mortgage debt is often negatively correlated with life satisfaction. The joy of being able to paint your walls whatever color you want is very quickly offset by the burden of the debt and the weekend spent fixing a running toilet.
There was a great anecdote we found from Reddit, the Personal Finance Canada thread we looked at. I loved this story.
Oh, the thawing pipe story?
Yes, you have to tell it.
So this guy posted about how he finally bought his absolute dream property, 40 acres, complete privacy, nature everywhere, the whole rugged individualist deal.
Sounds idyllic.
But then he described his actual reality. He spent an entire Tuesday in the freezing Canadian cold, army crawling under his house with a literal hairdryer, trying to thaw out his septic pipes because they had frozen solid.
A hairdryer on a frozen septic pipe. That is the glamorous, unspoken reality of homeownership.
And he said something really profound in that thread. He said he looked at his friends who were renting in the city, they were going to brunch, they weren't worrying for 1 second about where their waste goes, and he felt like he had been sold a massive lie. He had the land, but the land owned him.
The land owned him. That is powerful, and we are seeing a real generational shift here because of stories exactly like that. This is what the landing article highlighted in our source stack. Gen Z and millennials are approaching this entirely differently.
It is the shift toward flexible living, and it's driven by both necessity and preference.
Right. It's not just that they can't afford homes, though obviously student debt sitting at $1.7 trillion is a huge, undeniable barrier. But even the ones who can afford to buy are hesitating.
Because they place a higher premium on mobility. Staying in one house for 30 years is incredibly rare now. Young people move for jobs, they move for new experiences, they move because they want to try living in Denver for a year, and then maybe Austin, and then maybe abroad.
The idea of being anchored to a 30-year mortgage feels like a prison sentence to a generation that values a digital nomad lifestyle.
And the technology finally enables it seamlessly. You can tour an apartment in a completely different city via VR. You can sign a binding lease on an app in 5 minutes.
You can move into a fully furnished place with landing or similar services where you don't even have to worry about buying a couch or setting up utilities.
It is plug-and-play living. You essentially subscribe to your housing exactly like you subscribe to Netflix, and if you don't like the show anymore, you cancel and move to a new city.
And social connection plays a huge role too, doesn't it? Suburban homeownership can be incredibly isolating. You drive into your garage, the automatic door closes, and you are alone in your fortress.
It's the classic bowling alone phenomenon. Co-living spaces or vibrant, amenity-rich apartment complexes in walkable urban centers offer a built-in community. You have a gym, a lounge, neighbors you actually bump into in the hallway.
But for a lot of younger people, that spontaneous community is worth way more than an empty spare bedroom in the quiet suburbs.
Absolutely.
So let's bring this right to the present moment. It is February 23rd, 2026. What is the market actually doing right now? Because we have some fresh, high-level data from JP Morgan's global research forecast for this year. Is the bleeding going to stop?
Well, the patient isn't bleeding out, but the patient is in a medically induced coma. The headline word for 2026 housing is stagnation. JP Morgan is predicting that national home prices will stall at exactly 0% growth for the entirety of 2026.
Flatlining.
Completely flat. And that is a jarring change from the double-digit frenzied growth we saw just a few years ago.
What is causing that stall?
Yeah.
Why not a massive crash? And why not another boom?
It is a perfect storm of market paralysis. On the supply side, inventory is slowly, painfully creeping up. Home builders are trying desperately to move new units by offering aggressive rate buydowns.
But on the demand side?
Demand is completely muted. Prices are still hovering near record nominal highs, and mortgage rates are still elevated. Fixed rates are still floating around 6% or higher.
So affordability is just crushed for the average buyer.
Exactly. And we still have the massive lock-in effect paralyzing the resale market, or what I like to call the golden handcuffs.
Explain the golden handcuffs for us.
Okay, imagine you bought your house or refinanced in 2020 or 2021. You locked in a mortgage rate of 3%, maybe even 2.8%. Your monthly payment is incredibly manageable. Now, it's 2026. You just had your third kid. You really want to move to a bigger house.
But the bank quotes you 6.5% for the new mortgage.
Right. If you move, not only does the new, larger house cost more in principal, but the money you have to borrow to buy it costs more than double what you're paying now. Your payment might go from $2,000 a month to $4,500 for a marginally better house.
So you just don't move. You buy a bunk bed.
You stay put. You stay put. And because millions of people are making that exact same calculation and refusing to sell, there is no existing inventory for the new buyers entering the market. The whole system is just gummed up.
Now, we have a new administration in the White House as of last year. The Trump administration is back in power. Are the new policies helping break this logjam? Because J.P. Morgan analyzed the specific 2026 proposals.
They did look closely at them, and again, just looking purely at the economic math here, the conclusion is, do not hold your breath for a miracle. There are two main proposals currently on the table to try and fix housing affordability.
Let's run through them objectively.
First, there's a proposed ban on institutional investors buying single-family homes. The core idea is to stop Wall Street firms like BlackRock and others from buying up Main Street inventory.
Which, I mean, that sounds great on a bumper sticker. Stop the hedge funds from stealing our homes.
It plays incredibly well politically across the board, but J.P. Morgan's data points out that institutions actually only own about 1 to 3% of the total market. They are a tiny, tiny slice of the overall housing pie.
So banning them isn't going to suddenly flood the market with cheap houses and crash prices.
Not at all. In fact, the analysis suggests it might actually backfire, because a lot of those large institutions are currently funding build-rent communities. They are actually adding net new supply to the rental market. If you ban them from operating, you stop that new construction.
And less rental supply means higher rents for everyone else.
Exactly. You might accidentally hurt the exact people you were trying to help by driving up their rent.
The classic unintended consequences. Okay, what about the second proposal? The MBS purchase plan.
Right. The plan to have government-backed entities like Freddie Mac and Fannie Mae buy $200 billion in mortgage-backed securities, or MBS. The economic theory is that this massive extra demand will force interest rates down.
$200 billion sounds like a staggering amount of money.
It is a lot of money to you and me. But to the U.S. mortgage market, it's a drop in the bucket. The total mortgage market is roughly $14.5 trillion.
Trillion with a T.
Yes. So J.P. Morgan estimates that a $200 billion buy program would likely only lower mortgage rates by about 0.10 to 0.15%.
So it takes rates from, say, 6.5% down to 6.35%.
Exactly. It's a rounding error for a home buyer. It is not going to magically unlock the market. It's certainly not going to take us back to the 3% glory days.
So the reality of the 2026 market is going to be defined by stubbornly high costs, completely flat prices, and high interest rates. Which brings us right back to our central question today. Is it a good investment? Because if you buy today, you are buying near peak pricing with high interest rates and facing 0% appreciation for the near future.
From a pure clinical investment standpoint, it is a terrible pitch. If I pitched you a tech stock with those exact characteristics, high carrying fees, highly illiquid, guaranteed 0% growth, you would laugh me out of the room.
So is the final conclusion here never buy? Are we telling everyone listening to be a renter for life? Because I feel like we've been pretty hard on homeownership today.
No, and I want to be very, very clear about this distinction. It is not about never buy. It is about finding the equilibrium. It's about knowing exactly when the math makes sense to buy.
Talk to me about the 5% rule. This is a rule of thumb we pulled from the PWL and geometric data. And I honestly think it's the most useful practical tool for anyone listening right now.
This is the golden rule for making the rent versus buy decision without emotion. The 5% rule helps you directly compare the unrecoverable costs of renting versus the unrecoverable costs of owning.
Define unrecoverable costs really quickly.
Money that is gone forever, it vanishes. It does not build equity.
Yeah.
When you rent, your entire rent payment is an unrecoverable cost. 100% of it is gone.
Right, you never see that check again.
But when you own, people incorrectly think, oh, I'm keeping all my money, I'm paying myself. No, you are not. You are losing massive amounts of money to property taxes, to maintenance, and to the cost of capital.
Cost of capital meaning the interest you pay the bank plus the investment returns you are missing out on by tying up your down payment.
Exactly. The rule suggests that, on average, these hidden owner costs roughly equal 5% of the home's total value annually. So here is the math test for the listener. Take the total price of the home you want to buy, multiply it by 5%, then divide by 12.
To get a monthly break-even number.
Right. If you can rent a similar place for less than that monthly number, renting is mathematically the better financial deal.
Let's do the math live so people can hear it. Give us an example.
Okay, let's say you were looking at a $500,000 house, a nice standard suburban home. 5% of $500,000 is $25,000 a year in unrecoverable costs.
Okay, $25K.
Divide that $25,000 by 12 months. That comes out to roughly $2,083 a month.
So $2,083 is your magic number.
Yes. If you can rent a similar home, same size, same general neighborhood for, say, $1,800 a month, you are winning financially by renting. You are saving money compared to the unrecoverable drag of owning.
But if rent in that area for that house is $2,500,
then buying starts to make mathematical sense. You are better off paying the unrecoverable costs of ownership than paying that higher rent.
that is surprisingly simple. It completely cuts through the noise of the market.
It's a heuristic, sure, but it
Excellent.
works brilliantly. And geometric wealth adds the final and perhaps most important piece of advice to this whole debate. Buy a home for non-financial reasons.
Because you want stability for your kids in a specific school district.
Right.
Because you want to paint the walls purple. Because you want a garden where you can bury your... Wait, not bury anything, just have a garden.
Exactly. Don't bury anything. But buy it because it is a consumption good that you actively want to enjoy. Treat it like buying a luxury car or going on a lavish vacation.
You don't buy a BMW expecting to retire on its resale value. You buy it because you like how it drives. You buy it for the lifestyle enhancement.
That is such a liberating shift in perspective. It takes all the pressure off. You aren't failing at life if you rent. You aren't throwing money away. You are just consciously choosing a different asset allocation.
Precisely. You are choosing liquidity, flexibility, and historically higher stock market returns over forced savings, total control, and, well, thawing out septic pipes in the winter.
Exactly.
So let's wrap this up. We have covered a massive amount of ground today. We've looked at the hidden $16,000 carrying costs, the flat 2026 market predictions, the insurance crisis in coastal states, and the 5% rule.
It's been quite a journey through the data.
If we had to distill this entire deep dive into 3 key takeaways for the listener who is maybe driving to work right now, staring at a for sale sign and wondering if they should renew their lease, what are they?
Number 1, realize that a house is primarily consumption, not a guaranteed investment. The numbers, especially the hidden costs in 2026, prove that it is a very expensive asset to simply hold. It is a lifestyle luxury, not a strict necessity for building wealth.
I love that. Number 2.
The math of renting and investing the difference is incredibly valid. In fact, historically, it is often superior to owning, but, and this is the massive but that trips people up, it only works if you are fiercely disciplined.
Right, you cannot spend the rent savings on DoorDash and European vacations. You must invest them in the market consistently.
If you spend the difference, you lose the game. You
Yeah.
have to be your own bank. You have to force your own savings.
And number 3.
Let me take this one.
Go for it.
The American dream needs a total rebrand. It shouldn't be defined by a paper deed to a piece of land with a wooden box on it. It should be defined by ultimate financial security and lifestyle autonomy.
Yes. For some people, that still means owning a home and putting down roots.
But for others, especially in the realities of 2026, that means a flexible lease and a very fat brokerage account.
A lease and a fat brokerage account. That sounds like a pretty incredible dream to me, honestly.
It does to me too. It's freedom.
It is freedom. And I want to leave everyone with a final, slightly provocative thought to chew on as we close out. We talked earlier about how home prices are predicted to completely flatline at 0% growth this year. Meanwhile, the stock market, despite its normal ups and downs, continues its historical march upward.
The gap is widening.
It's widening every single day. So the question I want you to ask yourself is this. Are we collectively holding on to 20th century financial advice in a 21st century economy?
That is the real question.
And if the opportunity cost gap keeps getting wider, at what point does the old American dream of homeownership actually become the American nightmare for your retirement?
A very provocative question, but one we all absolutely need to ask before we sign our names to a 30-year contract.
Thanks for diving deep with us today. We'll see you next time.
Take care, everyone.